What's up, y'all? It's Xavier. I just wanted to stop in real quick and break down a little bit about two things that really sound complicated, but they really not complicated. It's the buy down and the temporary buy down and discount points. Now, if you're using your VA loan, like me, and you're 100% disabled, you want to be smart with how you use your money at closing. So, definitely let's get into it. Now, first, we have your temporary buy down, and it's basically say you got an interest rate of 6.75%, and that's your actual loan rate, right? But with the temporary buy down, someone puts money down into a little payment help type of bucket at closing. Usually the seller, sometimes it can be the builder, and sometimes you can do it as well. But the best version is always when the seller does it. Now, then for the first year or 2 years, your payment will be lower. So the most common one is called the 2-to-1 buy down. That basically means, so year one, your payment is like around 2% lower. Year two, your payment is 1% lower. And year three, it goes back to the normal rate of what you got, which is that 6.75%. So for example, say you got the loan rate for 6.75%. Year one would be 4.75. Year two would be 5.75%, and year three would go back to that 6.75. So the reason people like doing this is because it gives you that breathing room that you need. Definitely when you first move in, you got a new place, you got new bills, and y'all know how life happens. So it just makes the first couple years a lot easier. So the key parts of this is a temporary buy down is definitely best when you don't know if you're gonna keep that loan forever. So basically, if you're thinking about refinancing later, if the rates drop, the temporary buy down is the best option for you. Now, your discount points is a little different. So discount points means that you're going to pay that extra money up front to get a lower interest rate for the entirety of that loan. So basically, it's say you got that 6.75% with 0 points. You can make it lower going to 6.50% if you pay 1 point. So 1 point is usually 1% of your loan amount. So if you borrow 600,000, 1 point is $6,000. 2 points would be $12,000. Now, you're gonna have to pay that money right away, but it's gonna lower your rate forever. But here's what people really don't think about when they're thinking about that discount points. You got to think about breaking even, right? So the only way discount points make sense is if you're going to keep that mortgage for long enough to earn that money back that you just paid. So if you pay that $6,000 and it saves you around $100 a month, so $6,000 divided by 100, that'll be around 60 months. So that's around 5 years just to break even for that. So if you refinance in 2 or 3 years, you basically paid that $6,000 just to save a little bit of money every month, and then you ain't getting your money back. So that's why points are the best way for people like. So if I'm keeping this exact mortgage for long term, I'm not refinancing it, I'm not selling it, and I'm just gonna be sitting right here, it's probably the best option for you. Now, for people like me, where we every 3 years we PCS'ing, or whatever have you, you military families, y'all moving around, you're only gonna live there for about 3 years, then rent it out later. The best option, in my opinion, because a lot of times you're gonna refinance it later anyways, to lower your rate or change the plan or just free up your VA eligibility for another house. So in that type of situation, just in my opinion, I believe paying discount points out of your pocket is definitely not the move. And I want to emphasize, out your own pocket is not the move. So if anything, I would try to get the seller to pay for a temporary buy down, or get seller credits to cover the closing costs, or keep your cash and don't overpay up front. Now, if the seller pays your discount points, that's a whole different story, because you're not using your own money, so you're benefiting with this. All right. That's when I guess discount points will make a lot of sense. So basically, temporary buy down, it lowers your payment for the first year or two. You can use that 2-to-1 or that 1-to-0. It's great if you're gonna refinance later. Best when the seller pays it off for you. And the discount points, it lowers your rate forever. But it's only worth it if you're gonna keep that loan long enough, where you're gonna break even. All right. So if you want, drop your loan numbers in the comments. Let's talk about it. Your loan amount. Let's talk about your interest rate options, point costs, and I'll tell you straight up which one makes sense to me, in my opinion. This is all just my opinion. But go ahead, make sure y'all like, subscribe, comment, and I'll catch y'all on the next one. Peace.